Hello guys, welcome back to another great episode. This is episode 41 of how to build a logistics trucking business from scratch. Thanks a lot for your continuous support. It really means a lot. The journey has been amazing, we've had some learning experiences along the way, and you've seen some great driving skills that I have, apart from some accidents here and there. On this channel, you will learn some basic skills that you may apply in your day-to-day activities. Sometimes you may learn about business, sometimes about health, or even some crazy stuff you didn't know. Stay tuned for some fun. Today, I will be transporting soy milk to Osnabrück, and along the journey, I will explain about interest rates. Put on your seat belts as we head there, and don't forget to like and subscribe for more videos like this. Enjoy! What are interest rates and how does interest work? Interest is the price you pay to borrow money. When a lender provides a loan, they make a profit off of the interest paid on top of the original loan amount. Interest rates affect the true amount you pay for homes, cars, and other purchases made with credit. How an interest rate is determined depends on the type of loan. Interest rates play a central role in our financial lives, but sometimes it's confusing to sort them all out. You might pay 3.5% interest on your auto loan, 4.5% on a home loan, 13% on your credit cards, but only earn 0.5% in your savings. What's going on? Why are all of these interest rates so different? In order to truly take control of your finances, you must first understand what an interest rate means, who sets interest rates, and the effect interest rates have on your everyday budget. How does interest work? Interest affects the overall price you pay after your loan is completely paid off. For example, if you borrow $100 with a 5% interest rate, you will pay $105 back to the lender you borrowed from. The lender will make $5 in profit. There are several types of interest you may encounter throughout your life. Every loan has its own interest rate that will determine the true amount you owe. Before you borrow, make sure you understand exactly how an interest rate will affect how much you owe at the end of the day. What is considered a high interest rate? Every loan type has its own average amount of interest. The rate is calculated based on a number of factors, including the principal amount, the length of the loan term, the repayment schedule, monthly payment amount, market factors, the borrower's creditworthiness. Because no two loans are alike, it can be hard to determine what a good interest rate is. Your credit cards, auto loans, personal loans, and mortgages all have unique factors that are used to determine your interest rate. What is an APR? An annual performance rate, or APR, is another rate you may encounter when taking out a personal loan, mortgage loan, auto loan, or credit card. This rate is the amount of interest you will pay over the course of a year, including any extra fees your loan process may incur. The APR will typically be 0.1 to 0.5% higher than the interest rate. If the APR is higher, expect to have more fees. Many borrowers compare APRs when deciding between different loan options. These rates are valuable negotiating tools. It is not uncommon to reference the rate of a competing lender in order to secure the best rate available. How does mortgage interest work? Taking out a mortgage loan is the largest loan most consumers will ever have, so it's important to consider all the aspects of buying a home. The interest that mortgage lenders charge on the amount they lend to home buyers is based on the buyer's credit and the overall economic trends in the country. Over the past 40 years, the average mortgage rate, or interest rate on a mortgage loan has fluctuated between 3.56% and 16.64%. While purchasing a home is a great example of a financial goal, before you take out a mortgage loan, it's important to do your research to determine if now is the time to buy. If you want to find the best loan, take a look at each lender's quote carefully. Be sure to consider interest rates, closing costs, administration fees, brokerage fees, Some of these costs may be included in the April. Make sure that you inquire about what is covered before making a side-by-side comparison. How does credit card interest work? Unlike auto and home loans, banks and lenders have no collateral to collect in the event that a borrower defaults or stops making payments on their credit card. As a result, credit cards will have a higher interest rate than other loan types to offset overall losses. The average credit card interest rate is in the 14 to 24% range. Credit card balances are limited. If you handle them correctly, you can avoid paying significant amounts of interest. Credit cards are a great tool if you know how to manage them, but you don't want to end up with too many credit cards that you can't manage balances. How does interest work on a car loan? When you apply for a car loan, the car is used as collateral. Most lenders will require you to have auto insurance to protect the collateral while the loan is being repaid. If you miss any payments, the bank can repossess the car to cover the costs of the loan. Because the process of repossessing a car is fairly straightforward and doesn't cost the lender very much in fees, borrowers can expect lower interest rates on car loans. Auto loans typically have interest rates in the 4 to 5% range. How does interest on payday loans work? You may have heard about payday loans and their unreasonably high interest rates. But how can these loans have rates that are so high? A payday loan is a small, short-term loan used when money is needed immediately. Borrowers are expected to repay the loan when they receive their next paycheck. To encourage quick repayments, lenders will often use extremely high interest rates as service fees. For example, a payday loan might be as low as $100 with repayment due in 2 weeks. If this loan carries a $15 fee, then the APR will be around 400%. Unlike credit cards and mortgages, this fee is not repaid over the course of a year. Although $15 may not seem like much, it is a high interest rate compared to the $100 you initially borrowed. What are Federal Reserve interest rates? The Federal Reserve Bank, or Fed, is the central bank in the United States. This bank sets what is called the federal funds rate, a rate one bank will charge another bank for quick, overnight loans needed to meet their legal reserve mandates. The Fed also sets the federal discount rate, which is interest the Fed charges banks when they borrow from the Federal Reserve itself. These Federal Reserve rates impact the rates that banks charge for loan products. Generally, the Federal Reserve will raise interest rates in good economic times, and lower them when the country is facing recessions. Low rates encourage consumers to spend rather than save, thereby reboosting a receding economy. The rates are meant to help control inflation. Lenders will raise and lower their rates to match the Federal Reserve. An example of loans that will be affected by Federal Reserve rates include auto loans, credit cards, savings accounts, certificates of deposits, CDs. One interest rate that isn't directly affected by the Fed is your mortgage rate. Mortgage rates are affected by investors who buy bonds and mortgage-backed securities. Although a federal hike may have a small impact on mortgage rates, experts generally look to other factors. How does savings account interest work? Typically, savings accounts are viewed as opposites of a loan rather than borrowing money. You are providing money to the bank to loan to other people. As an incentive for keeping your savings with a bank, you will often be provided interest on your savings. Because the bank will be paying you rather than making money from your interest, the rates will be drastically smaller. The average annual interest rate is around the 1 to 2% range. Savings accounts also come with several stipulations. You may have limits on how you use the account, like minimum balances. Accounts with fewer limitations might pay lower interest rates. Saving accounts are best for emergency funds. To make more on your savings, consider investing in a savings vehicle that will earn you more. Other savings accounts that will increase your rate of return include CDs, retirement funds, money market funds, bonds. So, here are some key takeaways. Number 1, interest rates affect how you spend money. When interest rates are high, bank loans cost more. People and businesses borrow less and save more. Demand falls and companies sell less. The economy shrinks. If it goes too far, it could turn into a recession. Number 2, when interest rates fall, the opposite happens. People and companies borrow more, save less, and boost economic growth. But as good as this sounds, low interest rates can create inflation. Too much money chases too few goods. Number 3, the Federal Reserve manages inflation and recession by controlling interest rates. So pay attention to the Fed's announcements on falling or rising interest rates. You can reduce your risks when making financial decisions such as taking out a loan, choosing credit cards, and investing in stocks or bonds. Number 4, interest rates affect your cost of borrowing money. Always compare interest and APR when considering a loan product. We have finally arrived at our destination. The journey was amazing, and I hope you've learned something about interest rates and how they work. My client has paid me €3,380. That's a good amount. Thanks for watching till the end. Until next time, bye.